Welcome to the Capital News. I am your host, Alex Karitis. Thanks for joining me today. I hope everyone is doing well. Let's get right into the economic news of today. February the 20th, 2019. Let's look at the U.S. markets. The S&P closed up 5 points. The Dow was up 63. NASDAQ up 2. The Russell 2000, the small cap index, was up 7. Oil, gold, and silver, despite their rallies from yesterday, were muted and reversed, but just a little bit, nothing serious. And then the 10-year Treasury note remained at 2.65%. Some minor fluctuations. There wasn't a whole bunch of news that came out. Of course, today, the Federal Reserve released their minutes from their FOMC meeting back in January. So that was sort of the buzz around Wall Street today, and really global markets, because we live in a free market system where we cling to every word of policymakers. Of course, I'm being sarcastic. This is the whole problem with this whole process. We are not supposed to be clinging to every word from policymakers. The economy is supposed to be determined by you and by me, not by the president, not by the Federal Reserve Chairman, not by the Chairman of the Bank of Japan, the Bank of the European Central Bank, by the head of the Bank of England. No central banker, no prime minister, no president of any country is supposed to carry that much weight in sway over the economic affairs of the world, and especially not this country. So it's a shame that we live in this world where we cling to every word of all of these quote-unquote policymakers that always seem to screw things up royally. But it's the world we live in, so that's the game we have to play. So in that, we didn't have much movement in the markets because everybody was waiting to see what happened. What did the Fed say in January, following the fourth quarter volatility of the stock markets where we entered bear market territory? Now, of course, that's just a technical jargon, the bear market territory, because we went from recent highs and we collapsed 20%. It makes no difference. It's arbitrary. The 10% correction, the 20% makes it a bear market. I think we're overall in a bear market. You have to look at a whole bunch of other data points. But that makes the headline news, so we'll roll with it for the purpose of discussion. The news came out, and the Federal Reserve was not as dovish as everybody was hoping. Of course, I wasn't hoping that, but the markets, the drug addicts, they wanted their dealer to come out and say, hey man, I got the best stuff ever. This is the best. You're going to love me for forever and a day. That's not what happened. That's not to say that they were going to once again reverse and go back to what they said at the end of last year, where the balance sheet was on autopilot for the Federal Reserve to continue to sell their assets, reduce their balance sheet. You have to understand, ladies and gentlemen, and take a look at our website, thecapitalnews.com, thecapitalnews.com, capital with a K, and go to the K word and look at my article that I posted a couple weeks ago, because it's in regards to, obviously, here, the Federal Reserve. But I threw a couple of graphs in there for you to get a sense of what I'm talking about when I say zero interest rate policy, and when I talk about the Fed's balance sheet and the assets that they have on their books. At the height, their assets were about $4.5 trillion. $4.5 trillion. If you look at where their assets were back before the crisis, around the crisis, it was less than $1 trillion. This is, of course, unbelievable, but it isn't, because this is what they do. They were in a panic. They thought it was the end of the financial world as we knew it in 2008, 2009. They pulled out all the stops, printed as much money as possible, and they haven't really stopped. Now, of course, they have pulled back. I'm not going to deny that. You can look at the chart. It's on there. Look at the website. Look at the article. So currently we're at about $4 trillion. So we've come down about $500 billion. We spent a decade going from below $1 trillion up to $4.5 trillion. We spend basically 1 year coming down $4.5 to $4 trillion. And the markets throw a hissy fit in the fourth quarter of 2018. It enters correction territory, it enters bear market territory, and then the Federal Reserve sends out every man and woman they can to say, whoop, nope, listen. You misunderstood what we said. You didn't get it. We didn't mean we were going to take away the punch bowl. We weren't going to stop this morphine drip, this heroin drip. But you just misunderstood us. You misunderstood us. And so they do a policy 180. Instead of continuing to increase interest rates, instead of putting the unwind of the balance sheet on autopilot, it's now patient wait and see. It's going to be data dependent. Don't worry about a thing. We have everything under control. It's laughable, I know, but this is the game they play. And of course, in their minutes, and I'm going to get to that in a little bit, of course, in their minutes, they discuss the markets. Their mandate is to deal with full employment and price stability, or inflation targeting, which is what they do. There is nothing in their mandate, there's nothing in their charter that says that they are here to backstop the financial markets. Nothing. There's nothing. It's not in their charter. Yet they mention it. Yet when the market throws a hissy fit, they come and attempt to save the day. Now, a couple other things, because obviously we always expect something to be in the news in regards to U.S.-China trade talks. Well, before I started this, I did another search because there wasn't anything out in the day that said there's good news, there's good vibes, something's going to happen. Nothing like that. But I looked out of curiosity because the Asian markets were down earlier, because I do this program late in the evenings on the East Coast of the U.S. So the Asian markets are open by the time I start this podcast. Japanese markets were down. And then I go and I do some quick research after a little bit of doing some other business. And they're up. And I said, my goodness, it has to be, you guessed it, the U.S.-China trade talks. And here's an article. Let me read some of this to you. This is from the Associated Press and Market Watch. Asian stocks rise after report of outline to end U.S.-China trade war. Slow trading turns broadly positive as investors hopeful of deal. Asian stock markets shook off early doldrums Thursday following a report that U.S. and Chinese negotiators were outlining a plan to end the trade war. Tokyo's Nikkei 225 index rose 0.3% despite a gauge of manufacturing activity falling to a 3-year low, suggesting Japanese economic growth is slowing. Investors appeared encouraged by a Reuters report that said the U.S. and China had sketched outlines of agreements in principle in 6 key areas, including cyber theft, intellectual property rights, and forced technology transfer. Wow. U.S. stock market futures jumped immediately after the report, with Dow futures now up more than 100 points. Surprise, surprise. Earlier, a U.S. envoy said a meeting in Beijing last week made headway. President Donald Trump told reporters Tuesday the talks were going very well. Trump has suggested he might postpone the tariff hike on $200 billion of goods, but made no firm commitment. The article continues, the U.S. Federal Reserve reassured investors by releasing minutes of its latest meeting, saying, as expected, it will be patient with interest rate hikes amid economic uncertainty. In Japan, the preliminary reading on a monthly purchasing managers index fell to 48.5. That's the purchasing managers index. It fell to 48.5 on a 100-point scale from January's 50.3 reading. It was the second unusually large monthly decline in the PMI's lowest level since October 2016. Such large falls are rare and suggest that the economy is losing momentum, said an economist with Capital Economics. So, there we have it, folks. Despite continued negative news out of Japan, and that's a pretty big drop-off, by the way, on a month-to-month reading and a purchasing managers index, it stands at 48.5. In January, it was 50.3. So when it comes to these gauges, if you're unaware, 50 is obviously the midway point on a 100-point scale. Any reading of 50 or higher indicates that there is some sort of economic expansion, and likewise anything below 50 means there's economic contraction. So we're at 48.5 on the Japanese PMI reading. This is in addition to other poor economic news out of the area that continues not only out of Asia, but out of Europe, the US. We talk about it here all the time. You're familiar. But there was more news on U.S. trade talks, U.S.-China trade talks. So the markets do a complete reversal in the Asian markets, and now the Dow futures are up 100, at least at the timing of this report, which was not very long ago, maybe about a half an hour ago. And it's just a little past midnight here on the East Coast. So it's anybody's guess, at least at the time of this podcast, what the futures are on the American markets, what effect this will have on the early morning trading in the European markets, because we continue to have a no deal in regards to Brexit. Prime Minister of the UK, Theresa May, will be heading to Brussels, or she is in Brussels, trying to save a deal, make a deal, something that she can take back to the UK Parliament for them to agree on this time, hopefully, by the March 29th deadline. Or there very well may be a no-deal Brexit, which, of course, was on our list of 30 risks in 2019 by Deutsche Bank. So we have a couple things left on that list, so let's jump into those. We left off yesterday with talking about some Chinese and Japanese market fluctuations. Obviously, we're in the midst of that now. We just read to you the PMI out of Japan. Not good news. But we'll see how this plays out because, hey, all's well. All's well. U.S. and China are going to make good. They're going to make a deal. Now, I am surprised, according to that article, whether or not this is going to be true news or not is another story. But at least for the time being, we're given another breadcrumb. We're told there's good news. And it seems to be on the meat and potatoes of everything. There's an outline sketched that pertains to IP, technology transfers, cyber theft, all that stuff. Now, it's an outline. I don't necessarily know what that means, right? There wasn't a lot of detail in this article. Wouldn't you think they might have had an outline to begin with? I mean, sort of you go into a presentation, you know what you want to do, so you have an outline. Or is this an actual outline of a deal that's going to be made? Now, that's how the article reads, that it's going to be an outline of something more to come. But that's all we've ever been told. We've been strung along here for the past 60 days. 60 plus days, because we only got a couple weeks left until the March 1st deadline. There's 10 days left, so we've been going at it for 70, 80 days here. I don't get it. Is there going to be an extension? Because we have markets teetering. We have them hitting technical levels. They didn't move much. The Federal Reserve didn't come out dovish enough for these markets to rally in a major way. This is the last thing standing. that these markets can cling to for hope. Hope for it to go up. And hope is not a strategy. Hope is not a policy. But that's what we want to cling to for whatever reason. If you know, tell me. I'd like to hear about it. So let's continue with our 30 market risk for 2019 provided by Deutsche Bank. We left off yesterday with point 28, which was continued increase in global inequality, and we had that conversation. All of this money printing, all of the political uprisings, the rise of populism, the rise of nationalism, the rise of socialism, depending on where you are. It's all giving way, all coming to a head, 2019, 2020. And there's a lot of elections worldwide this year and next. Point number 29. Fed and ECB, the European Central Bank, restart quantitative easing and risky assets don't rally. Well, we timed that one right, didn't we? Because today we had the Federal Reserve issue their minutes from their January meeting. Now, they are going to continue to be in wait-and-see mode. They're not going to be increasing or decreasing the federal funds rate anytime soon, maybe. Of course, it's data dependent. But the gist of the meeting in the minutes said that there is no rush to increase rates because that was the former trajectory, right? We're going to normalize interest rates. Then the markets threw their hissy fit. They didn't like it. Nope, we're going to pause. So they're still in wait-and-see mode, and it's going to be data dependent. But then there was a further discussion of their balance sheet. Again, earlier I spoke about it being at $4.5 trillion at its apex. Now it's at about $4 trillion. How much further is it likely to run off? Well, according to the minutes, it doesn't seem like it's going to go down much further. If it should get to $3.5 trillion, they might call it a day. So that's still going to be a few trillion higher than where it was in 2008, 2009. So still quite the stimulatory effect. Now, it's a reflation and inflation type of game here. This isn't real growth. This isn't real organic growth. I talk about that all the time. This is simply money printing to reflate and inflate financial assets from their lows in the 2008-2009 crisis. And to keep this game, this charade, afloat for as long as humanly possible. So this is a very important point that Deutsche Bank is making on this list. Because they're saying that both the Fed and the ECB restart quantitative easing. And risky assets, being stocks primarily, don't rally. So that goes right back to my point that I've been preaching here about diminishing marginal returns. Do you know what kind of scenario that will create if the Fed and the ECB and other major central banks, such as the Bank of England, the Bank of Japan, People's Bank of China, if they restart quantitative easing or a whole new round of stimulatory policies and risky assets don't rally, and in fact they sell off, what are they going to do as a backstop? Where is the bottom going to exist? Do you understand what I'm saying? Do you understand the gravity of this situation? The potential of this risk in 2019, 2020 that Deutsche Bank is making? It's the same point that I have made. This is serious stuff. If you thought 2018 Q4 numbers were bad, with the U.S. stock markets entering bear market territory, you ain't seen nothing yet. If the Fed and other central banks go back to what they were doing with quantitative easing and stock markets do not rally. What does that mean? That means like what I said yesterday. The medicine, the quote-unquote medicine that has kept the patient alive is going to get one more dose, and the medicine that's kept him alive is going to kill him. I can't make it any rosier than that. That's as nice as it gets. That's as good as I can explain it. Because once you take away what has been stimulating the economy, and specifically financial assets, stocks, bonds, real estate, currency markets, you know the list. Once you start taking that away and it has no stimulatory effect, watch out. Watch out. Where's the bottom? I have no idea. I have no idea. We know that President Trump yesterday tweeted out, if Hillary Clinton had won, the market would be down 10,000 points. 10,000 points. That might be where it ends up. If the Federal Reserve goes back to quantitative easing, and that stimulatory effect does not have a stimulatory effect. That's quite the risk. And we know, according to the minutes, now of course we know, I use that very loosely because we knew last year that this was going to be on autopilot, now it's not, that if and when the balance sheet of the Federal Reserve hits $3.5 trillion, they're going to be done. Now, what comprises this balance sheet? Well, of course, U.S. Treasuries. They were buying U.S. Treasuries in the trillions and trillions of dollars that got them up there to $4.5 trillion. But they were also buying mortgage-backed securities, MBS. Remember those things? A whole bunch of mortgages that are bundled together, comprised of prime and subprime loans. A whole bunch of things that ended up being toxic assets on the books of the banks. Fannie, Freddie Mac. Remember that? Well, the Federal Reserve said, hey, you know what? We'll take some of those off of you and we'll put them on our books. Well, now they're going to start continuing to sell them to a point, get them off of their books, throw that junk back out into the market. We'll see who buys it. And then we'll see that's going to be such a hot potato because those things still aren't good. Believe you me. They're still not good. And we're cooking up here one of the biggest recessions we're ever going to have. Because I think a lot of these risks that we have been talking about for 2019 and 2020 and some things that we don't even foresee is going to hit us. It's going to hit us in the face like a frying pan. I don't say this to scare you. I say it to get yourself prepared. But that's a big risk, and it's something that's been in my mind for quite a while. It works until it doesn't. Point 30, and this goes to the same thing. Monetary and fiscal policy are out of ammunition, and the world experiences a Minsky moment. Same thing we were just discussing, except this time they threw in fiscal policy, which is policy coming from the government. Subsidies, tax cuts, additional government spending. Of course, that would be funded by money printing, which is quantitative easing. The Minsky moment that they're talking about refers to a situation very much akin to 2008-2009. You have a major sell-off or a major collapse in financial asset prices. And as a result of that, you have a downward spiral that just keeps getting deeper and deeper and deeper. And depending on the catalyst, who knows how deep it goes, the rate at which it declines, and what type of policy measures exist to stop it. Well, if it's caused in part by a restart of quantitative easing that has no lead in those bullets anymore, and fiscal policy has no lead in their bullets anymore, where else do you turn for capital? Where else do you turn for credit? Where else do you turn for liquidity? I mean, you can't make it up. They are making it up. They're printing it out of thin air. Now it has no effect. That's not a good situation. Now, is anybody out there in the mainstream, are they coming out and telling you about this list? Or any other serious things? No, not at all. They have us distracted with a border wall. They have us distracted with the Oscars not having a host, an MC this year. Who's dating who? Is Tom Brady playing football next year? These are the big things that Americans need to pay attention to. Don't pay attention to the man behind the curtain. Don't pay attention to the policies that are going to affect your pocketbook in a very personal manner. Pay no attention to these things. Be more concerned with the sports and the Hollywood gossip, because God knows that's the most important thing on Americans' minds. And then you sit and you scratch your head and you wonder why these people continue to take advantage of the people of this country, people of this world. Because if they figure, hey, if I can distract all these people with this stuff, well, then, they're not smart enough to know any better. So I'll go take a little bit of everything over here, a little bit of everything over there, and then before you know it, what is it, 1% of the world's population controls 90% of the assets? Makes sense, doesn't it, when you look at it like that? Now, point 31, and I, of course, added point 31. Deutsche Bank was never going to add point 31 to the list. Why? Because it has to deal with Deutsche Bank. Deutsche Bank fails in a Lehman-like scenario, and a domino-like effect takes hold. So if you remember from 2008, 2009, you had you had several big bank failures or collapses. The first one to sort of kick off was Bear Stearns. But Bear Stearns was absorbed with government assistance into J.P. Morgan. Later on, we had the collapse of Lehman Brothers, which was a banking institution that's been around, I think it was over 100 years at the time. So to think that, institutions that have been around for 100 plus years can't fail is ridiculous. They can fail. But when you have an organization like Lehman Brothers that's that big and is that intertwined with so many other corporations in this country and around the world, you have that type of systemic event that took place, and you had that domino effect. And people said, holy man, if Lehman Brothers, an institution that everybody knows about, that's been around for 100 years, can collapse, then maybe so can we. Maybe so can all of these other organizations that have that prestige and have been around that long, or not as long. And what happens in that scenario is credit tightens, liquidity just dries up, nobody trusts anybody because people, if Lehman failed, we can fail. What was bad on their books, maybe it's bad on our books too. And nobody wanted to do business with each other. So there's your downward spiral. And then you start to have all of those financial assets starting to collapse. There's your Minsky moment. So it's a lot to ponder, but don't worry, everything's going to be fine because we have the U.S.-China trade talks going in the right direction. Stay tuned for tomorrow, folks. It'll be a doozy. Thanks for joining me. This was a lot of fun. Please like, share, subscribe. Get the word out. Leave your comments. I'd love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.